Welcome back to another episode of Property Now. I'm Michael Carboni. My friends call me Carbs, and there's a lot of friends on this episode. We've gone back and found the best bits, the best advice for first home buyers. So we speak to brokers, we speak to buyers agents, we speak to first home buyers themselves. There's some great tips, great advice here. If you're a first home buyer, potential first buyer, know a first home buyer, share this with them because there's a lot of great content right here. If you're interested in the full version of any of these episodes, those links are in the show notes. We'll be back next week with a full episode, an original episode of Property Now. Looking forward to that. We'll see you then, but until then, enjoy the tips.
I was always wanting to get into investment. I was looking at stocks and trading options for a bit, but I realised that property, there's just so many benefits and incentives and opportunities for a young person. I should be maximising them while we can. Like the first home buyers initiatives. Yeah. There's that was probably the biggest thing. Just being able to borrow money at such a large extent to get such a solid investment and the security in that. That's what we were after.
A lot of people tell a similar story. Like there's nothing, I mean, I invest in shares as well. Mm-hmm. I own property, but you know, you can certainly leverage the property side more just because of the way incentives and the way it works here in Australia. And you know a lot of these things as an accountant. Yep. But you can actually borrow someone else's money, pay it back over time, and hopefully make some equity.
Yeah, of course. And there is risk to that, obviously. But there's risk and reward, so you got to weigh those things up.
Yeah, it's a long-term game.
And I was really nervous about putting it all into a deposit that I wasn't going to see for a long time. Yeah. So when co-deposit came up as an option, that completely changed the way I viewed it. I saw it as something I can pay off over time, and instead of digging into my savings, I just budgeted it into my weekly income and expenses. And so I was able to essentially keep my deposit and just pay the 10% over time.
Buy with as little as 5% with a lot of the government schemes now. And even we do a lot of guarantor loans, so we do get help from not the bank of mum and dad, but the property of mum and dad. And essentially you can buy with literally zero deposit. So if you've got no money to your name, as long as you've got an income to support the ongoing repayments, we can jump in with no deposit. So that's going to save you years.
And how's that work, the bank of mum and dad or the house of mum and dad? How does that zero, because I mean people are going, oh what, I don't need anything, I just need to be able to service it. How does that actually work? Let's get technical with that.
Well, in terms of guarantors, so I like to think of it as collateral. Yeah. So if we have, let's say for example, you're buying at 700,000 and you want to borrow the full purchase price. So you can literally borrow 700,000. Now, the banks traditionally want at least 20% equity in the property or 20% deposit. That's their general level of comfort. So they might lend you 80% of that. Whereas if a parent, and I typically say parents because 95% of the time it is mum or dad or both. But we're doing a lot now. Even sisters and brothers are helping where they've jumped in 5-10 years sooner. They've built up equity and we can leverage against it. So in terms of when we're doing a guarantor loan, it's all about collateral. So again, the 700K purchase price, 700 property, bank's not comfortable. So what we do is we add in a second property and then the bank has more collateral in case you default. And then all of a sudden they're happy to lend against that value. Wonderful product. You save lender's mortgage insurance. Yep. You get interest rates as if you had a 20% deposit. Yep. And the main thing is time. Yep. So you can jump in years, if not decades sooner. LMI is probably the third or fourth option we go through. So normally, if you don't have... So normally we try and get you to have the cash deposit. That's the easiest and simplest way. If not, we'd look at any potential government schemes. If not, we'd potentially look at the guarantor option. If not, then we'd look at the lender's mortgage insurance option. So again, that's typically if you have less than a 20% deposit. The banks will apply a premium. It's normally around 1 to 3% of the loan size. So let's say it's 700K. It could be, depending on how much deposit you have. If it's a really small deposit, it could be more like 3%. Yep. If you have a bigger deposit, still less than 20%, it could be around 1% of the price. So let's say 700,000, it could cost between 7 and 21,000. However, if your property goes up 30 or 50 or 70,000 in that same time, you're still laughing. So
you kind of covered it.
Yeah, I just think of it as similar to a stamp duty. It's the cost of doing business. Sometimes it's just a means of you getting in the market today, paying today's prices instead of prices in 3 or 5 years, which are probably going to be 50, 100, 200k more than the number one way to pay off a loan quicker is to have money in the offset sooner. Really, you want to be building the offset up until the point that it reaches the same as the loan balance. So loan 700k, your offset might start with 5 to 10k. Let's be honest, a lot of first home buyers, they're all in. They don't have much cash left over. So the goal for me is to build up the offset account. So the offset gives you ultimate freedom. So you can pull out that cash for renovations, if you need to buy a car, if you want to invest in shares, start a business, whatever it may be, rainy day fund, you've got instant access to the cash. Whereas redraw, again, going back to the, log into the internet banking, the redraw is technically putting your cash physically into the home loan. So you're actually paying down the loan. So it might be 700k and then it's 699, 698. The restrictions for that are a lot of banks, if you want to then pull out the cash, they'll make you jump through hoops. So you might have to fill out a form, you might have to pay a fee. There could be a time delay. So it could take 7 to 28 days to actually release the cash. And next one, obviously check with the tax accountant with this, but in terms of the tax implications, and I found this the hard way when I bought my first place, because I was using the redraw. So it's a lot cleaner for your first place if you keep your cash in the offset, because if you turn your property into an investment in the future, you basically haven't shot yourself in the foot from a tax deduction. So if you put it into redraw, you're paying down the loan. It means if you upgrade later, you buy a family home, for example, you've lost some of that tax deductibility. So I prefer to keep it in the offset. It's a lot cleaner. When you buy your second place, you can almost just drag and drop that offset against the new place.
100,000, you just go boom, straight into the next. I like that. And offset, literally, you're offsetting. So if you've got 100,000 in your offset account and you've got 700,000 owing, it's like you're paying interest on the 600. Is that correct? Yeah. So, and that is interesting.
What should a consumer be looking for when it comes to this sort of quality trust? What's the first thing they should ask when they're looking into a property?
Well, firstly, what credentials do you have and your team? Because it's not, as I said before, not just the developer, it's the developer and the builder and the rest of the major team members. And what's your recognition by your own industry? Where are they rating you? And so we proudly display all of that on our literature as well. But yes, and look at their last 5 projects, and don't just look at this year. Look over the last 5 or 10 years, and what's their real track record.
I like that you guys stick to areas as well. You're not running away from a neighbourhood. You're building a neighbourhood. I love that. Brad, same question.
Pretty simple. As a part of doing their due diligence, check if they're ICERT rated. Go to the ICERT register, icert.com, and verify that they actually have earned their independent trust credentials.
This is Jason He, the sexiest voice in property, here to tell you that the Property Now podcast offers opinions on Australian property news for informational and entertainment purposes only, and general in nature. It does not take into account your objectives, financial situation, or needs. It does not constitute professional advice. Always seek expert guidance before making any property-related decisions.